Good afternoon, everybody. It's Gordon Stone. I'm one of the directors of the Agri-Business Development Institute who are hosting this particular workshop or webinar session today. Our topic is very topical from the point of view of many people out there in the agri sector and also the beef industry. In particular, one of the backgrounds to the business mentoring program is for people to think about the opportunity to get external capital into their business. So that's what we're doing today, at an overview level, investigating how that might be. I have with me today the chairman of our ABDI Advisory Board, Damien Street. Damien is a corporate advisor. Welcome, Damien. Thanks very much for joining us.
Thanks for having me, Gordon.
So just a few housekeeping things to get us started. The very first thing is that we normally keep these webinars to around about 30 to 45 minutes. So that's what we'll be doing today. We're very aware that we have varied line speeds, download speeds and so on in the listening area, so to speak, and so we keep everything very low key. What that will mean is that Dave, who's sitting out in the background in Cyberland, will be keeping an eye out for any questions that come in. So for this particular webinar, we're just going to keep everything as pretty much a question and answer session between Damien and myself, given that we've both had some experience in this investor space, and that's the particular area of Damien's expertise. In terms of the where to from here, we're going to ask you at the end if you've got some questions that you'd like to pose to Damien or to us collectively, and that will probably set up a part 2 of this webinar, and then ultimately, if the interest is there, as we expect it is, that we'll be heading down the track of a workshop program either later probably in October or November this year. So one remaining piece of housekeeping, for those of you who are on telephones, you'll be listening in and watching the PowerPoints as we scroll through them in your paper copies. For those of you who are on computer, we've got you all on mute, and so we'd like to keep everything nice and simple in that respect. So let's get started now. A bit of context. The business mentoring programs are built around what we call 12 pillars of business best practice, and they're set out in front of you, which is a clear vision for the business, thinking about the marketplace, thinking and acting at a corporate level, particularly as we engage with our customers, obviously thinking about money, thinking about our people, thinking very systematically, and also being very aware of risk, legalities of doing business, succession, value-adding leverage, sales and marketing, and communication. Ordinarily, I would say they're the principles of best practice, which they are. However, in the case of attracting an investor into your business, these are all very fundamental to how you go about the process of attracting an investor, and that's to some extent what we'll be covering off today. So if we look at the slide in front of us, which is the slide that has pillar number 9, succession, fundamentally getting an investor into your business is either about managing the bigger picture of the business or looking at some kind of an organised succession strategy. So in terms of our agenda today, what we're proposing to do is to set the scene with some key principles of an investor or attracting an investor and what we need to do in our business, looking at the specific opportunities that exist for investors. We've put ourselves always in the customer's shoes, which is to look at the expectations that investors might have and how we match up our expectations and their expectations, and ultimately get down to the point of view of how we get started. So Damien, just before we move on to the first session about setting the scene, do you have any overview concepts that people really need to think about when they're looking at the idea of an investor, attracting an investor, setting their business up for investment?
Certainly, Gordon. Well, it's clear that raising external equity can be very difficult depending on the condition of the business and how well it's organised right now. Mm-hmm. Bearing in mind that some say, and I agree with this, that raising actual equity is the most expensive form of debt. Mm-hmm. So you'd want to make sure that the current owners would want to make sure that they've exhausted all debt opportunities before considering capital raising. But having done that, then there's certainly a huge appetite in Australia today for investors wanting to invest in sound enterprises because interest rates are so very low. In fact, in the $2 trillion invested in superannuation in Australia, the average rate for the 12 months ended 31 March was 1.5%, which is extraordinarily low, probably doesn't even cover inflation. So there is an appetite out there for investors, yes, most definitely.
Great, okay. So Damien, one observation I'd like to make, and we're going to go to an example that's very topical before we even move into today's session. Damien and our business have been involved in a number of these capital raising exercises, and there's actually nothing like the discipline of creating a business that's ready for investment to make the proposition very, very attractive for banks. So I think that's probably something that's important as well. Now, Damien, when we first, or before we started this session today, you actually drew my attention to an offer that's out there in the marketplace. And I guess I'm going to ask you to maybe read off the application criteria and just a bit of background without giving any names or confidentiality.
Well, this is from one of my associates who sent me an opportunity for me to invest, actually. And it's, as it turns out, it's in the agri sector. And it's interesting that this particular colleague has an investor that wants to invest $2 million. They are looking not for a minority investment, but they're looking for a majority investment, which means over 50%. Certainly may not suit everybody, that concept. They want an existing business that would be profitable with sustainable margins over, they don't say 3 to 5 years, but they say mid-term. They're looking for a return on invested capital, which can be both capital gain and income of around 20%.
In that 3 to 5 year time, do you reckon, or 3 to 6 years? Or?
Yeah, in the 3 to 6 years, yes. They're looking for a location preference is Southeast Queensland. They're hoping that the business they invest in has got some sort of intellectual property or even products, and ideally the business would have existing customers within the livestock agricultural space. And finally, they want to be able to see that the business, it can be scalable. In other words, it can replicate itself and grow. So, I mean, that's just a live example, really, of one investor's out there with $2 million. There's numerous others, but that's just a very current one.
Okay. So we would assume, based on our experience, that those criteria are the sort of things that, broadly speaking, an average investor, whatever that is, would be looking for. Something along those lines.
Yes, I'd have to agree with that. I mean, there are a lot of other factors that aren't included in that particular memorandum from my colleague, but yes, they would be the prime ones.
Okay, so let's get started. So we've moved now to the slide setting the scene, why external investment. And so the objective there was to ask you what it would be, from your point of view as a corporate advisor, that a person may use the capital for, and maybe some of the caveats around that external investment process.
So clearly every single owner-operator is absolutely unique, and so the final analysis must include a total customisation of their needs in order to arrange what I call an optimum capital mix. And investors can, their needs vary from income yield to no income yield, capital growth to no capital growth, and there are a whole lot of different instruments or security types that can be used to get cash into the business, which may fully attract capital growth and may not attract any capital growth depending on the structure. I don't want to go into too many technicalities of the description of those securities at this seminar, but certainly there is an absolutely diverse range of appetite for a variety of different structures to put capital into a business.
Okay, and so if we look at this slide here, if we put ourselves in the business owner's mind who's looking to attract investment capital, basically we've said that there are a number of golden rules, which are expanding the business, desired succession, and business development plans. And we've had a couple of examples of people who actually did have very specific expansion plans, and we counselled them that that really needed to be integrated into their succession plan. And our definition of a succession plan is not necessarily handing the property over to another generation. It may actually be to setting the business up for sale, or it may be to have other people come into the business. It may be to get involved elsewhere in the value chain, which would be then to do facilitating those business development plans. So is there any observations you have about that accessing capital for those purposes?
Absolutely. I mean, any investment, whether it's in the agricultural sector or not, investors are fundamentally risk averse, although private investors are less risk averse than, say, people who are interested only in public securities such as bonds and the top corporates. So what they want to see, the ones who are interested in the private market, whilst naturally they're expecting to mitigate or minimise the risk, nonetheless that their fears will be greatly reduced if the business owner can demonstrate that they're savvy, that they're hardworking, that they're honest, they have great vision for the business. In other words, there's going to be growth. And to achieve that, they also have to demonstrate that they're sufficiently disciplined, such that the business adopts, say, sound corporate governance practices. Now, I'm very, very passionate about this because I personally believe that from having raised about 50 tranches of capital in my time so far, that where a company can demonstrate that it has size-appropriate corporate governance policies, that will lower the risk to the investor, but simultaneously it also is of great value to the company, whether they're raising capital or not, actually. So it's the reduced risk does two things. One, it raises the entry price that an investor will pay. So a very poorly run company, you might sell, for example, just picking a figure, say 20% of the company for $1 million. In a really badly run company, the 20%, you might only get $500,000 for that. So if you've got sound, size-appropriate corporate governance policies, or you've groomed your company so as to present to the investors in a manner that the risk is contained or reduced because of those policies, you're going to get a far higher price for the share that you decide to sell.
Okay.
That's really critical.
Good. Well, let's dig down to that a little bit more as we go on. So I'm thinking that now we should probably, as I'm watching the time as well, ask ourselves what the investor opportunities are out there. So who's out there? Because the question is always asked of me, who are we talking to in terms of potential investors?
Well, without sounding trite, I mean, some of the biggest investors in Australia in the last 20 years have been Belgian dentists.
Oh, really?
So look, there's a very wide grab bag of different types of people. There are simple high net worth individuals who are looking for opportunities. There are investment banks that put syndicates together who are totally passive investors. There are a variety of financial planners who have superannuation funds that are prepared to invest a small percentage of their investments in private opportunities. There's even these days there's even crowdfunding, some opportunities there. So the investor has to be tailored for the type of person. I mean, they have to, there has to be some sort of relationship built if it's just an individual, or if it's a fund that's investing, then you don't have to get to know the syndicate members at all, but you have to be able to demonstrate to the fund managers that this is a sound opportunity.
Sure.
There's a wide variety available, actually.
Okay. And my understanding is that there are a range of high net worth individuals as well who are deciding that now is the time for agriculture, now is the time for the beef industry, and they would like to get involved in some way, shape or form in that. So some are very specific, some are more general. Would that be the case?
Well, yes. The Financial Review in the last couple of years demonstrates every third or fourth day great investment in agriculture, and agricultural-based properties. So investors are interested in not just Australian and international shares and infrastructure and private equity, but they're also interested in fixed interest investments and also direct shareholdings in companies without going via a fund or a managed fund or a public securities organisation.
And that being the case, if they wanted to go for direct investment, those are the people who'd be looking for a very disciplined, structured approach from the perspective of the business owners to give them confidence that it would be a lower rather than higher risk.
Absolutely. Well, look, the same principle applies whether it's a large investor or even a small investor making a direct. They will engage their own lawyers and accountants to examine the risk for them as well as form their own views. So the principle of the matter is that getting back to the issue of strong corporate governance, or size appropriate corporate governance, those principles apply whether it's a large investor, should I say, or an individual.
Okay. So we've moved now to the slide where we're talking about investor expectations around a structured blend of income producing investments, the whole full spectrum of investments which you've just described I think a minute ago, and private markets are less risk averse than those seeking government-backed securities. Now to me you've also made a very important point, which is that anyone looking to attract an investor into their business is going to have to understand that the investor or their advisors will be having a close look at what's on offer. And we're coming in a minute to the concept of an information memorandum, which we'll deal with in a moment. But essentially, and we've already had an experience like this with one client who said, look, I want some money to do this, and we went through a process with him to try and get him as clear as possible about what his end game was, how he saw the business being built over time, and I would say at the end of the experience it didn't meet his needs so much because he wanted great flexibility in what he was going to use the money for. And I think yourself and the other associate that we dealt with at the time said this is actually one of the examples where anyone seeking an investor into their business has to be very disciplined, because those advisors who will be accountants and financiers and others will be going through the business with a fine-tooth comb from a risk point of view. Is that, am I summarising that correctly?
You are. It's actually quite ironic because large corporations, which through their size and profitability appear to have a lot lower risk than smaller companies or businesses, invest millions in risk mitigation or corporate governance, whereas the smaller companies simply can't afford to have in place massive risk mitigation strategies. So the view that, or not the view, but my experience is that, to go back to, without exhausting the subject, but having size-appropriate ones, corporate governance policies. That is absolutely essential. So,
and you're speaking from experience here, because you're a person who's put up your own money.
Oh, absolutely, yes. I've invested in over 50 companies in my time, plus I've examined hundreds of others. So.
Yeah, for yourself and for others, and sat as chairmen on boards and things along those lines as you are with us. Okay, well, let's just keep moving along. So that's, to some extent, starting the conversation about expectations of investors.
If I can just make one other comment, Gordon, and that's in relation to, without going into too much detail, the actual structure of investments. That it depends on the purpose of the funds. I mean, the funds might be used, for example, an existing business wants to do a startup, set up a separate division, and it might be a highly speculative agricultural development plan. Under those circumstances, the type of money you want is not one that pays monthly or quarterly dividends or interest, but ones that pay zero interest. And we've actually made investments before where what I call a zero coupon bond, where it's fundamentally a capital gain. So there's no cash outlay each month or each quarter or each year for the,
on behalf of the business owner to pay the investor their interest, we'll call it in simple terms.
On the other hand, you find, I mean, if I use this phrase loosely, but if they're mums and dads investors, some of them do like 6 monthly dividends or 12 monthly dividends because they like the cash flow. So it does depend on the purpose that the current owner-operator wants to use the funds for. That's pivotal.
Okay, so now you've talked about, and I do want to get onto this slide, which is about the management team. You just talked here about mum and dad investors. Can you define that a little bit more?
Yeah, a mum and dad investor is, to me, is somebody who they're probably full-time employed. They have close to zero experience in business.
Mm-hmm.
They're not what we call sophisticated investors, and they generally place their funds through financial management or financial planners,
yeah,
or directly, people like banks, people like Macquarie Bank, for example, and those people who are the experts then place the funds.
Mm-hmm.
So they're highly inexperienced investors.
So they're placing their money into a specialist area,
syndicates, unit trusts, yes.
Sure. And I know the other gentleman we've spoken to about the investment opportunities does have various syndicates and things like that he works with too, as I understand it, of varying types, seeking varied returns.
Yes, and there are numerous around Australia who do it.
Okay. So Damien, this particular slide that we've got here at the moment actually talks about the management team, and I know you were focusing on the skills of the management team, which is actually where our business mentoring program comes in as well. So could you just, I guess, expand on what it is that would make a management team a good risk for an investor? What's that all about?
Certainly. Look, an analogy is, my view as an investor myself is that if an owner-operator has a business plan,
mm-hmm.
And I'm exaggerating here, but if it's a 100-page business plan, I would like to see 99 pages describe the management and 1 page for actually what they're going to do with the money.
Yeah.
Because management is pivotal. If you put 2 McDonald's stores next to each other in the same street, one is going to perform better than the other, and that's only because of the management. So the management team, or the manager, CEO, managing director, owner-operator, whatever you want to call them, they have to be able to demonstrate that they are clever, that they are smart, that their plans are sound, that they have strong management controls in the business, that they're disciplined in terms of their risk management. They regularly have accurate financial reports. They've got a sound operational business plan, mm-hmm. and they're actually capable of executing it. And plans like that will only ever be executed if the management are actually committed to doing it.
Sure.
And that's the greatest risk that, where companies fall over, generally it's because of bad management.
Okay.
So an investor will be quite picky about getting to know the owner-operator, mm-hmm. or managing director, and they will then form a view of his capabilities or her capabilities.
Okay. So Damien, we are going to move to the next slide, which is more about the corporate governance practices and things.
Mm-hmm.
But I guess I do want to draw attention to the point that you've just made, because I know it's a recurring theme in all the years I've known you about management teams and their capacity to execute.
Mm-hmm.
Like that's one of your absolute golden rules, and I guess the absolute golden rules of many investors out there. Is that right?
Absolutely, it is. That is pivotal.
Okay, so let's look at the appropriate investments from the point of view of those corporate governance practices. So this is talking about risk, it's talking about money, it's talking about operations, and we're actually going to move into the notion of an advisory board, mm-hmm. as a way of, mm-hmm. discipline, focus, clarity, structure, accountability.
Mm-hmm.
So would you like to elaborate on those corporate governance issues?
Look, risk is a subset of corporate governance, as is compliance a subset of risk. So companies that can demonstrate an ability to be able to manage those regulatory risks, as a director of a company, mm-hmm. I know in Queensland, for example, there are 122 statutes, mm-hmm. that a director is exposed to. So not only for the good of the existing owner-operator is risk management pivotal, but it's equally pivotal for an investor coming in who's, say, in a minority position, might own 10% of the business. They want to know that there is a disciplined approach to management control in particular, quite apart from the marketing and operational issues that are the essence of the business, but the management control has to be quite strong, and that is demonstrated through then the owner-operator having a sound strategic plan, which is more of a visionary statement, and then converting that plan into, say, a 12-month operational plan. And then I'm a strong believer, particularly with private companies, that you have a board of management that essentially can comprise usually the top people in the company, without them actually being directors. They don't actually have to be directors, and a lot of owner-operators don't want other directors, which is fair enough. But at least there's this discipline of meeting regularly where you go through what your plans were and how you went against your plans. And that is a very cheap but effective way of monitoring what's going on. So as a absolute minimum, I think an investor would want to know that the CEO, the managing director, is having at least monthly or quarterly meetings where there's a pre-agreed agenda. It's not just financial, we also cover marketing developments and the operational aspects. So
sure,
it's not a big. I mean, you're talking here maybe 2 or 3 hours a month. And my experience is that where key staff in a company are involved in this process and they actually prepare the reports, they get an enormous amount out of it, because all of a sudden their if you like, their job descriptions change from just doing what they have to do to get their salary, but all of a sudden now there's a degree of accountability because they're filling out reports that are reviewed at a high level each month, and that transforms companies actually, because it's a tremendous incentive for staff to be able to do that and become involved in it. So,
okay, so if we turn, so we're taking that slide in front of us, which is about financial reports, strategic and operational plans, or in our terms maybe 180-day plans, advisory boards, and so on. There are many people in agriculture who say, well, I'm not sure that I want anyone else necessarily peering over my shoulder, or that I want, let's say, a person from the city interfering with what I'm doing, because they may have no idea what's actually going on in this business, or it'll be too hard to explain it to them. What is your, and I'll be saying, look, do these people have a say in my strategic plan, my operational business plan, my 180-day plan? Will they want 50 pages every 6 months? So what's your reaction to that level of thinking?
Well, as I said earlier, every single request to raise capital has to be customised, and every single business owner that I've ever met has a different view almost on this issue that you've raised about the involvement, let's say, of a stranger in the business. In fact, a lot of them don't like it at all. But having said that, where there is a desire to inject capital into a company or a business, there are basically 5 control issues. If I said earlier that the investment doesn't actually have to be shares, it can be various forms of bonds or debentures or quasi-securities such as preference shares or convertible notes. It can be guarantees actually. Now, if they are shares, then an existing owner-operator has to consider, there are 5 control issues. There's investments that are under 25% of the business, then there's the 49 threshold, then there's a 50% threshold, the 51% threshold, and the 75% threshold. And they are all strategic, which we probably don't need to go through that right now, but it's pivotal that an owner-operator understand at least the impact of those 5 control issues and what it could have. If it's under 20, I will say this though, if it's under 25%, then, and they are shares, then technically speaking, in the absence of any other shareholder agreement, then the company is responsible once a year to give a report at the annual general meeting and to field questions. I mean, that's the sort of minimum amount of legal responsibility to report.
So Damien, what I might do is there may well be some questions that come out of this either today or more likely after the webinar today, and it may be that we will hold some of those discussions about shareholding, different ways of accessing, managing money to a future activity, so to speak. Just moving along to the next one, next slide, which is about completing our discussion about investor expectations. we've observed here that attractive growth and business opportunities, attractive return on investment, an attractive period, and a realistic exit strategy. Mm-hmm. So I think we've probably dealt with the first two. I'm not sure that we've dealt yet with, or touched on briefly at least, the idea of that exit strategy.
No. Okay, so if I can just make one point first, that is that an investor fundamentally will invest in a company provided there are growth opportunities. Mm-hmm. Having said that though, a lot of investors actually invest in companies that are in serious financial decline, believe it or not,
yeah,
because they can see that as a result of a restructuring of the business, that there is future growth capability as a result of simply, let's say, getting rid of debt, for example, or there's a viable restructuring plan that makes the return on investment over, let's say, a 3 to 6 year period quite attractive. So it's not just for going concerns and high growth companies, it can also be for companies or people that are in dire financial need, but they need someone to support them in the business over the next, let's say, 3 to 6 years. Turning now to the exit strategy, again, that does depend upon the negotiations with the investor. The last one I was involved with, which was it was actually $500,000 from 4 investors. That particular investment was in the form of a loan for 3 years, and after 3 years the investor was able to make a decision whether to convert the loan into shares, mm-hmm. in which case they paid 100% premium for that privilege, or whether, if they didn't want to convert their shares into their sort of loan into shares, then they had the opportunity to get their money back 2 years later. So it was really a 5-year plan with an option of converting into ordinary shares in 3 years. Now, under that particular regime, the exit strategy for the investor was that they get their money back if they don't convert. The hard part is what sort of exit strategies are available if they are shares, mm-hmm. and let's say the investment is less than 25%. The reason I mention that is because if an investor has 25%, then that shareholding is required. You need 75% for an existing owner to sell the business. So if someone's got, over 25%, say 26%, then you have to get their permission. Under that 25%, unless you don't have to get their permission. So what sort of exit strategies are there? Well,
Damien, what I'm thinking, I'm just watching the time and thinking that a number of the things that you just raised, because I imagine there'll be people listening to this who'll be thinking, well, actually, I do have some financial circumstances that I need to address, particularly if I'm coming out of a drought or I see growth mm-hmm. opportunities with the current market. Mm-hmm. I can see people listening in and going, okay, I need to think about this exit strategy a little bit more. Mm-hmm. I need to think about how I could get some money into the business and how it would come out, mm-hmm. And what the circumstances would be, what I would lose, what I would gain, what the investor would lose, what they would gain. Mm-hmm. So I'm thinking that we'd be better off at this point and I'll just put it out there, that we'll cover that off in another webinar, mm-hmm. and say that's the sort of thing that we may deal with in a bit more detail.
Yeah, suffice to say there's probably at least 5 or 6 sensible exit strategies that would normally be negotiated at the beginning.
Oh, excellent. Okay. So now let's turn now to the next slide, which deals with an information memorandum. So I've got an information memorandum here that we've jointly prepared. It covers off an overview about the business, the investment highlights, the opportunities, succession, the investment decision, which is a summary, background on the business opportunity, talking about the marketplace, talking about the business's business model, talking about its engagement with other customers, its financials, understanding, the market positioning, digging then into detail in the investment opportunity, how investors' funds will be used, how the scenario for the investor will be managed, and how to get started. So we've put in this slide here that's the last chapter in the book, creating the information memorandum. Could you maybe, given that that was a real example that I've just read off, could you summarise in broad terms those points that are on that slide there, and maybe what this information memorandum is really all about?
Certainly. Well, I should say that the first chapter of the book, using that analogy, is the grooming preparation process.
So maybe I'll turn to the next slide and we can...
Yeah, sorry. Yeah. Well,
that's okay.
The first chapter of the book is the preparation, so the grooming or making ready the business for a third party to come involved. Once that's done, once the grooming is ready, then the next or the last chapter of the book is what document do you need that you can put before an investor to attract their interest, and that is what's called an information. It's called a few different names, but private placement memorandum, information memorandum. Common word is information memorandum. And okay, so as you just sort of indicated there, Gordon, the critical areas are covered all from an investor's point of view. What is the opportunity here? How are they going to do this? How strong is the management? How are they going to get to market? The specific proposals for applying the capital throughout their organisation. What the financial position of the business would be as a result of raising the capital, what was it before, and those historical aspects. Trading or forward estimates profitability, otherwise known as trading budgets, and also budgets of capital expenditure. So how much are you going to actually invest in capital on, say, plant machinery or livestock or whatever the requirement is. And then, of course, you've already alluded to the fact that it covers the risk management and legal aspects. I mean, in broad terms, that's it. There's an enormous amount of detail other than that, but they're the sort of primary areas that will alert an interest, attract an interest by an investor.
Okay, so I'm thinking, if you don't mind, I might summarise these two slides, which is the last chapter and the first chapter. So if we think of it from the point of view of the first chapter in the story, what we're saying is that a person seeking an investor needs to have a degree of clarity or a high degree of clarity about what they're seeking to do. So I'll move on to that next slide. Then what they need to do is to say, if that's my game plan, how am I going to make it real? Under those circumstances, I've got to start setting my business up or being in a position to describe it in a logical manner and demonstrate how it's going to happen. Then if we turn back to that previous slide, the information memorandum actually summarises what's happening in practice, what the intention of the management team is to do in practice, and then what it's going to mean in terms of the longer term return on investment. Is that a reasonable summary?
That's a very good summary, Gordon, yes.
Okay, fine. Well, I'm just aware that we're 40 minutes into this now, Damien, and that we already do have a game plan to go to the next, to another webinar, particularly if we get some responses back from people after this webinar. So what I'm thinking is this is heading towards the end of this presentation, and that's the notion about the benefits of the grooming process. So in the conversations that we've had before, we've also talked about this, as I see it in this context, and you might like to comment. If a person sets their business up in such a way that an investor can come into it, which is the grooming process, and starts to implement everything that they've said they're going to do to get to that long-term end game, then that in itself is going to be of immeasurable value to the business, whether or not they go to an investor, whether or not they go to a bank. It will actually just give them often the clarity that's required for them to manage their business appropriately. Is that, do I read that correctly?
You do read it correctly, and to me it's pivotal because the value, one of the biggest issues with an investor coming in is what is the entry price which they pay. And the entry price from the investor standpoint is a function of their risk assessment of the business. If it's really high risk, they assess it as being really high risk, then they will seek to pay a lower price because the risk's higher. That's just the way it works. If, however, through having size-appropriate corporate governance policies, that lowers the risk assessment or perception by the investor, and they will pay a far higher entry price than otherwise would be the case. I see this time and time again, including a massive one this year, a couple of months ago, where the price was double because the vendor or the person raising the capital had spent 2 or 3 years, in fact 3 years it was, setting size-appropriate corporate governance policies. And that raised the price to an unbelievable yield, and purely because of the corporate governance policies.
Okay.
And I think anyone listening to this who is in business should adopt the proper corporate governance policies, irrespective of whether they're raising capital or not.
Sure.
Because one day, when there's an ultimate harvest, they will benefit from it.
Sure. And that's, I guess, the core that's behind this business mentoring program, or our mentoring programs overall, is to help people make that change and transition from where they are now to set those governance policies up, to set the operations in their business up, to have a clear end in mind or end game, and then to get everyone to come on the journey with them in a disciplined and focused manner, given that on the one hand they've got to often do the work, while on the other hand think strategically like a CEO or a member of the senior management team.
I'd say this, Gordon, that one of the areas of resistance that current owner-operators have is that in this particular area of capital raising is that, look, we all have different skills and motivations to be seriously organised, disorganised, sloppy, as close to perfect as you can get. And part of this journey of grooming is moving from slightly, or let's call them informal management controls, where you're absolutely not accountable to anybody other than perhaps your spouse, girlfriend or bank, to all of a sudden there's a third party who now has an interest, and they want you to present yourself as being disciplined, as being organised. They won't invest if you're sloppy or lazy or you give that appearance anyway, no matter how brilliant you are. So, you know, I really do think that that grooming area is so important, because it culminates in the information memorandum, which then they read, and then if they're interested, they'll talk to you about it, and then form a view about, you know, whether you are disciplined or motivated and motivated and so on. So
sure.
It's a pivotal area.
Thanks, Damien. Well, drawing this to a close, I'd like to make an observation about what you just said, and that is we've been involved in negotiations on behalf of some of our customers with their customers. So in other words, people who are saying, look, I want to engage in a certain marketplace. The disciplines that you're talking about, we also know from past and personal experience, gives a customer, whether it be as a meat processor or a supermarket or somebody in the Asian market or whatever, a high degree of comfort, because they can actually see the discipline behind the supply of a reliable product in a structured, organised and focused manner to certain quality requirements and so on.
Indeed.
So that's where we, I guess, see the overall picture of complete benefit, which is not only getting extra money into the business, but actually running the business in a more structured or focused manner. So, Damien, at this stage, I think we'll draw this gradually to a close, because I know we're up to 45 minutes now. So I'm going to just put on the table that I've made a whole stack of notes here about things that I think people are going to be interested in, which are almost too numerous to summarise at this stage, but effectively they are about areas of resistance, price and yield, governance policies, long-term thinking, long-term plans, recognising that what people in some level of financial need might be able to do and the benefit they might be able to get out of involvement of an investor. So those, amongst others, are potential areas of real interest. So I think by drawing it to a close, I'll ask Dave in a moment if there's any questions that have come in, but the context in which this program is being developed, which is the next slide, is the Beef Business Mentoring Program that we're involved in, and what has caused this webinar to come about, which is basically to do what we're doing today, to provide some insights for people to think about what they're doing in their business, be exposed to opportunities and different ways of thinking, to, if they see that there's a need to do a stock take of what's going on in their business, what they want to be doing differently, to take a day away from their business. The one-day Better Beef business workshops or business by design type workshops are a way of doing that kind of stock take. The CEO mentoring program is I guess the ultimate end game in a program like this, where people could actually go through the change process that we've just described. Mm-hmm. And I'd almost put it in simplistic terms that if a person was going to develop an information memorandum and groom their business, the CEO mentoring program, which you're aware of, would probably do that job because it would help people think through that process of change. Would you say it's...
Yeah, I'd agree with that. I mean, in an ideal world, if people want to raise capital, the longer the preparation time, the better the result will be for them. Uh-huh. Seriously urgent applications are usually very difficult to arrange because investors they shy away from urgent cash flow needs, unless it's a serious insolvency problem.
And maybe a big upside for them as well, but then that becomes high risk, I suppose.
But look, having these sort of programs, you're right. This is about the change from informal management controls to more formal management controls, and that's a journey.
Yeah.
So the more time they've got to conduct that journey, the better informed and the better the change process will be, in my opinion.
And I guess the more structured it can be, the best all round. Okay, well, I'll draw this to a close, Damien. So I'd like to thank you very much for your time in participating in this, because I know we've talked about it a lot. I know many people that we speak to in the beef industry and the wider agricultural industry and elsewhere in the value chain are very interested. We have a engagement with a company called Moore Stephens Queensland, a group of accountants, and I speak to some of their people and they say there's an increasing interest in this issue of external capital. So I think that anything we can do to help people think this through is a good thing. So if anyone is interested in what we've been talking about today, there are a range of contacts, email addresses. There's also my phone number in case a person wants to give us a call. And certainly on this particular occasion, we do actually have to provide a disclaimer to say that, as you would expect in today's marketplace and legal climate, that people can accept this information as being a general in nature, but inevitably, as you've said many times during this presentation, we need to dig down into people's individual circumstances, and inevitably, ones that we've been involved in today, we talk to people's accountants, financial advisors, and other people.
Lawyers,
lawyers, because they're all part of the mix. So Damien, as we draw it to a close, is there anything that you'd like to say by way of final comments?
No, I think I thank you for the opportunity of addressing the subject. It's a vital subject, and happiness is a positive cash flow.
Oh, excellent. What a good way to leave it. Thanks, Damien. And so people listening in, Dave, have there been any questions that we need to address at this stage?
G'day, everyone. There's a couple of questions, but I think, we'll probably, given time, we'll respond to them individually, but I think also they'll probably form the basis to be included in probably the next webinar. So, yep.
Okay. Thanks very much, Dave. So, ladies and gentlemen, look, we're now up to 50 minutes, so I do apologise. The intention was to keep it shorter, but we also tend to go with the flow as people, as a conversation unfolds. So, as you complete this webinar, there will be a short survey, and the importance of that is that people, apart from our business and MLA and others behind it, always like to get feedback on what people have got out of an event like this. And furthermore, you may receive some contact from us afterwards, because I will probably want to be checking about the 8 or 9 different things that I've noted down as being possible areas of secondary webinars and other sources of information, and potentially for us to set up a workshop accordingly. So thank you all very much for attending, and we'll draw this to a close. Thank you all. Bye for now.